Hello friends, market update Tuesday 16th of June. Very strong day in markets yesterday. Following the negotiated settlement in the Middle East, the deal has finally arrived, which is due to be signed on Friday in Geneva between the US and Iran. Markets unsurprisingly have welcomed the news with open arms. The oil is currently trading at 3 months low. Tech stocks are near all-time highs. Pretty much, in all three main indices in the US are very much close to all-time highs. All markets were up yesterday. All major markets were up yesterday, particularly those which are energy importers, with the likes of South Korea, Japan. So there is likely going to be a peace dividend in my view, because this was the worst disruption on record for oil. We haven't had this level of disruption to the oil market ever in the recorded history. So yes, markets are celebrating. Yes, markets are always forward looking, but in my personal view, what market isn't appreciating at the moment is the potential for reacceleration in inflation due to the lagged impact of what has already happened. The CPI headline inflation in the US came out at 4.2% to the end of May. Right, we have the CPI print in the UK and Europe coming out tomorrow. We have the Federal Reserve's interest rate decision tomorrow. Not expecting anything there. The point I'm trying to make is, ordinarily the standard inflation target is about 2%, right? In the US, the inflation is twice that level at the moment. And still markets are celebrating, having a party as if nothing is happening. Which is, in my personal view, this is not advice or anything, which is a cause for concern. What normally happens is markets tend to get caught off guard by these factors, as we saw a couple of weeks ago on Friday when a very strong employment report came out of the US. So despite the war, despite the ongoing negotiations in the Middle East, markets fell quite heavily. So going forward, I think, yes, there are some positive signs. The health of the global economy remains quite strong. It has suffered 2020's COVID. It has suffered the regional banking crisis in 2023 in the US. It has withstood the Russia's invasion in Ukraine, which sort of carries on from 2022. It has sort of tolerated the Liberation Day tariffs saga. And despite all of these events, markets are still standing strong. And part of the reason for this resilience in the global markets is the economic conditions remain fairly strong, particularly in the US. And the earnings growth remains quite robust in the US. The S&P 500 companies grew their earnings by 28% in Q1 2026 versus the previous Q1 quarter from 2025, which is very, very healthy. So what are the risks facing the markets in my view right now? The biggest risk is the inflation reacceleration. The future course of Federal Reserve, that is the biggest risk. The second biggest risk is geopolitics. Yes, the deal is about to be signed, but I won't be personally surprised if something else starts in the Middle East. If Israel or Lebanon or Israel or Iran sort of restart the war, the US is relatively much less willing to get involved, at least in the short term, with midterm elections just around the corner, which doesn't help Donald Trump at all, particularly the prices at the pumps in the US. So inflation reacceleration, geopolitics. The third biggest risk, I think, is concentration. The US market remains heavily concentrated. Top 10 stocks is S&P 500 index make up about 40% of the entire index. At the height of the dot-com, they made up about 30%. So it has never been this concentrated. The semiconductor index, PHLX index we call it, that is also extremely extended in my personal view. None of this is, of course, advice. So these three, I think these three are the key risks for markets to take into account, at least in the short term. As I always say, diversification is the only lunch, not even free lunch. We used to say that if we can't find diversification in the US because the market cap weighted indices are heavily concentrated. And now the same argument can be made for emerging markets, because the emerging market index has been very much carried by three stocks: TSMC, Samsung, and SK Hynix. But having said that, there are stocks, there are sectors within China, for instance. There are AI competitors similar to what we currently have in the US and some other EM countries I've mentioned. There are similar competitors, similar equivalents to these stocks, which are trading at much lower, much attractive valuations. And I personally won't be surprised to see an episode similar to what we saw in the case of DeepSeek. Gold has been also under pressure, isn't it? People might be wondering what on earth is going on with gold. It was down about 20% from its peak a couple of days ago. Yes, it has come back a bit. So people can't get their head around what's going on with gold. Remember, gold doesn't yield anything. It's a non-yielding, non-income producing asset. So whenever the real yields go up, particularly in the US, gold always struggles. Ordinarily, it has always struggled, and which makes sense. To put it simply, when US government bonds become more attractive, when do they become more attractive? When their prices fall. When yields go up, US govies prices fall, they become attractive because they pay an income, regular income, that makes gold less attractive, because gold doesn't produce anything and you still have to pay the insurance cost, the storage cost, etc. But over the last couple of days, it has come back quite strongly. Why? Because the macro backdrop is starting to become more favorable for gold. Why? Because there's an expectation for an impending rate cuts further down the road. The odds of a rate hike have been pushed back from December this year, based on derivatives market, to March next year in the US. So now, following the deal and the negotiated settlement and the news from the Middle East, markets are now expecting a rate hike from March next year rather than December this year in the US. And here in the UK, the expectation for rate hike from the Bank of England has been pushed back from September to November. If there is more progress around what's happening in the Middle East, and if it doesn't take too long to clear out those mines in the Strait of Hormuz, then I personally I won't be too surprised if there is no expectation for a rate hike at all. So these are, I think, some of the key issues I wanted to highlight in today's video. As always, if you have any questions, drop them in the comments. This channel is all about building wealth in a slow, progressive, disciplined manner through the power of compounding, inspired by value investing, Benjamin Graham, Warren Buffett, time in the market rather than timing the market. It's incredibly difficult to time the market. That's why I'm all about long term. I will provide you frameworks, educational, general market commentary. None of this is financial advice, all my personal views. and not the views of my employer at all. So if there are any questions, drop them in the comments. If there's anything that's bothering you, you can't get your head around a certain asset, why gold is falling or climbing, what's going on with SpaceX, or any stock or any macro events, drop them in the comments, and I'll get back to you. All the best. Cheers.